Phil, so great to see you.
See you.
I want to talk about the price action that we're seeing today. Really some good enthusiasm after yesterday, but it's sort of this sell-off into the close. And I'm wondering if that is healthy risk-taking or if that's sort of a broader sentiment risk-off day mood that sort of we're seeing that's indicative of something bigger going on.
Yeah, what a roller coaster the last few days, including today, as you mentioned. So we see this a little bit as a rotation, which makes sense to us. So rotation maybe out of those high-flying semi-names, which we still like. Okay. Like Taylor, we write about the semi-trade over the next 3 years, over the next 10 years as a long-lasting trade. But if you have a view, like we do, that oil prices probably settle in around $80, that the 10-year Treasury, you mentioned 4.5%. That's the magic number to me, right? Like if we settle and rate volatility settles down, you could see some rotation into pro-cyclicality as you get more and more certainty around the U.S. economy in the second half of the year.
So pro-cyclicality, you're looking at, do you still like chips? Or, you know, are you still doing AI? How do you sort of view the cyclical trade?
Yeah, so we're still doing AI for sure. It's always operating in the background, and we're overweight information technology. And when I think of cyclicality, I think of things like consumer discretionary. Think of things like financials. Like the consumer is top of mind for me. If you could get the U.S. consumer right, you can get your entire asset allocation correct. And, you know, I've been making the case that the high-end U.S. consumer, so the top 20% of earners in this country, do 60% of the spending. So in other words, they determine success or failure on this economy. And do you realize that they only spend 2.5% of their disposable income on oil, gas, and electric? So they're very insulated. And then you throw the Big Beautiful Bill Act, which is coming at a big, beautiful time, right, for consumers that are getting hit with these higher oil and gas prices. I think that creates a lot of insulation, I think, to these moves higher in gas and oil.
There have been some concerns about the 10-year to 4.5. We started the year pre-Iran conflict, 396.
I know, we were right below 4%.
Right below 4. So is 4.5, does that worry you? Is that a headwind for equities to move higher? Or can that be a tailwind for equities if rates are rising because I'm seeing pro-growth in the future?
Yeah, that's a really good question. I love the way you phrase that because rates move higher for a bunch of reasons. They can move higher because people are worried as heck about inflation. They can move higher because they're worried about a fiscal situation of a government, like what's happening in the UK. Or they can move higher because of the pro-growth environment. And we would lean to that third lever, right, which is that rates at 4.5 mean that growth is on solid footing. And for us, it's more not what the rate is today, but the volatility of those rates. There's nothing that gets equity investors more nervous than when they think that something crazy is happening in the bond market. Like just look at 2022 as an example. So the 4.5 does not scare us at all. That's normal. Over a long period of time, the 10-year note kind of looks like nominal growth, which is inflation plus real GDP. And that's at about 4.5, which is exactly where the 10-year note belongs right now.
How do you think about some of this AI spend? So we were talking on a show earlier about Apple, which has been great because they're not spending CapEx. But Meta, Alphabet, you know, all those big hyperscalers are massively spending on CapEx. Are we sort of over that fear because the AI trade is real and it's here and I don't mind that you have this earnings super cycle to power the CapEx?
Yeah, I think that's the key. If it was a multiple expansion and that's it, okay, and these companies weren't earning or didn't have free cash,
which is price going up faster than earnings?
Faster than earnings, then we would be a little bit more worried about a euphoric trade. And I compare the semiconductor just demand to trying to find tickets to the Knicks at Madison Square Garden, right? It's supply and demand. There's 20 million people in the New York area, and there's 20,000 seats in Madison Square Garden. There's a 70% increase in demand for semis right now, and a 30% increase in the supply, which is driving this AI earnings super cycle.
Okay, so I look at you and I say Marvell Technologies, Jensen Huang says it's the next $1 trillion company. Micron, $1 trillion company. Now they're off today, but they're up 250% year to date. I come to you and they say, I'm interested, but I'm worried about valuations. I'm worried about investing in companies that are up 200 to 300% year to date. What do you tell people like that?
I tell people watch their earnings and obviously don't be concentrated into too many, single names. But this is part of an AI super cycle, AI ecosystem that we think is going to last years. So if you have them down on a day or a month, okay? That's okay, because this AI trade for us is generational. It's a structural trade that we think is going to look like the internet.
The next move from the Fed, hike, hold, or cut?
Well, hold. That's an easy one, right?
Okay.
Right. That's next June. But then that's on next week. But after that, I continue to believe it's going to be an ease at some point. In order to tighten policy, you have to believe that inflation and rates are going to be higher in the second half of the year. And we believe that peak inflation and peak rates is happening right now. And if we're right about oil prices going back to 80, then the rate of change on inflation starts to slow. Fed on hold for the rest of the year, and possibly can re-engage in an easing cycle.
So a 4.12 on the 2-year, isn't the market jawboning the Fed and saying your Fed funds rate at 3.5 to 3.75 is too low?
Yeah, absolutely. But central bankers aren't trading those contracts, right? The market is trading those contracts. And I really believe that the trend on inflation is solely in energy and commodity prices. It's not yet slipping into things like a wage price spiral on the labor market, or parts of core inflation like recreation or restaurants and food away from home. Those are the things that we would look at, which were all piling up in 2022 and 23 when they had to be so aggressive. So hold for the rest of the year, and then maybe re-engaging on their easing policy next year.
Biggest risk to this equity market?
Rates.
Really? Not the Iran war?
I continue to point to that. Well, the Iran war is kind of tied to that because of oil prices. So oil going to another 50% higher to 150, right? Never a sign of zero probability in any event. That would be a risk. And then the rate story. If the Federal Reserve were to engage and kind of seep into a tightening policy and make up a policy mistake, that would be something that would worry us.
Phil Camporeale, this was so fun.
Yes, good to see you.
Equities, rates, AI, all of it. Thank you for joining us. All right, shares of jam maker JM Smucker, they are surging today.